December 21st, 2025. I'm reviewing the COMEX warehouse inventory update, which is refreshed every business day on the CME's official site. One particular number jumps out, and for anyone who understands what unfolded in 2011, it should be alarming. COMEX's registered silver inventory 92, 4 million ounces. Reminder, verify the actual current figure at CME. Delivery reports before publishing use real-time data. To those unfamiliar with the silver market, that might sound like a hefty amount. 92 million ounces. That seems like a lot. Right, not quite. Back in April 2011, the last time COMEX inventories approached a level that sparked a historic price surge, the registered inventory stood at 105 million ounces. Today, we're 6 million ounces lower than that, and 12% beneath the threshold that triggered a massive rally, where silver jumped from $33 to $49 in just 6 weeks. That was a 48% gain in a month and a half. What makes this even more concerning is the nature of today's buyers. In 2011, the rally was driven by retail speculators leveraging borrowed funds. These investors were vulnerable to sharp market moves. In response, COMEX hiked margin requirements 5 times in 9 days, which forced speculators to liquidate. The rally collapsed, but here in late 2025, the buyers look very different. Major corporations like Samsung are constructing battery gigafactories requiring up to 50 million ounces of silver annually. Tesla is expanding electric vehicle production. Chinese firms are churning out 80% of the world's solar panels. These industrial players aren't trading on margin. They're not panicked by volatility. They need the physical metal to keep production running. You can't margin call Samsung out of the market, and that changes the entire dynamic. In this breakdown, I'll explain why 92 million ounces may be far closer to a critical threshold than most people realize. We'll go over the math behind silver drawdowns. I'll highlight 3 key levels between now and inventory depletion. And I'll lay out the timeline because, at the current rate of decline, the window is closing faster than most expect. This isn't a theory. The data is public and updated daily. COMEX publishes these figures openly, and the numbers are sending a clear message the paper-silver system is running short on actual metal. Let's break down exactly what's happening. Before diving deeper, we need to clarify the definitions used by COMEX. The exchange categorizes silver into 2 types, eligible and registered. This distinction is absolutely essential. Eligible silver refers to metal stored in COMEX-approved facilities but owned by private entities, miners, funds, wealthy individuals. It's physically present but not necessarily available for delivery unless the owner decides to make it so. Think of it like silver sitting in a warehouse with a sign that says, "Not for sale." Registered silver is an entirely different story. This category refers to metal that has been officially designated as available to fulfill delivery requests on futures contracts. When a trader demands physical settlement on a silver futures contract, the COMEX pulls from the registered stockpile. This is the liquid inventory, the actual supply that backs the paper-silver market as of December 21st, 2025. Let's break down the numbers. The total COMEX silver inventory, combining both registered and eligible categories, stands at around 320 million ounces. Of that, 4 million ounces are registered, meaning available for delivery. The remaining 227, 6 million ounces fall under the eligible category, privately held, and not available unless the owner chooses to make it so. Here's the key point over the past year. Registered inventory has been steadily declining, week after week, month after month. The number shrinks. Meanwhile, the eligible inventory has barely budged, because the private holders of that metal are watching the rally unfold. They see supply tightening. They see industrial demand heating up. And they're thinking, why should I offer my silver to the COMEX today when it could be worth double in a few months? These holders are not contributing, they're observing, which means the number that truly matters, the one propping up the paper-silver system, is the 92, 4 million ounces in registered supply. And that number is falling fast. Quick disclaimer, I'm not a licensed financial advisor. This is not investment advice, just educational commentary based entirely on public data. Let's rewind to 2011, because if you don't know market history, you risk being blindsided. At the start of 2011, silver was trading near $30 per ounce. COMEX registered silver inventories were sitting comfortably above 100 million ounces. Market conditions appeared stable, but then things shifted. Retail investors, disillusioned after the 2008 financial collapse, began pouring into silver as a symbolic protest against the system. They bought futures. They hoarded silver coins. They began demanding delivery on contracts. Simultaneously, real-world demand was strong. Solar energy was expanding. The electronics sector was thriving. As a result, registered inventory started to shrink. By April 2011, COMEX registered silver had dropped to about 105 million ounces. Still a significant amount, but the market sensed a crunch coming. A short squeeze was forming. Open interest, the total number of outstanding contracts, was massive. There were more claims on silver than physical ounces available. Then the price action turned explosive. On April 11th, 2011, silver traded at $33. By May 1st, just 6 weeks later, it had surged to $49. A 51% rally. Holders of silver saw windfall gains. Short sellers took heavy losses. But then came the crackdown. In a coordinated response, the COMEX and major banks raised margin requirements once on April 25th, again on April 26th, and 3 more times through May 5th. That's 5 hikes in just 9 days. Suddenly, anyone holding leveraged silver positions needed 5 times more collateral. Most couldn't meet the new requirements. They were forced to sell. By the end of May, silver had plunged from $49 back to $33. The short squeeze was broken. The banks weathered the storm. But the key takeaway: it took drastic, coordinated action to stop the surge. 5 separate margin hikes in just over a week. An aggressive move. And even with that, silver never returned to $20. It held steady at $33. The supply problem was exposed. The crisis was merely delayed. Now, fast forward to December 21st, 2025. Registered silver inventory stands at just 92. 4 million ounces. That's already 6 million ounces lower than the 2011 level that triggered a runaway rally. But here's why this time around is far more serious. Back in 2011, the main buyers were retail traders and momentum-driven hedge funds players using heavy leverage. Often 0 to 1 or even more. Once margin requirements were raised, they couldn't keep their positions. Forced liquidations followed. But in 2025, it's a different kind of buyer, major industrial companies. In November 2024, Samsung announced the construction of the world's largest solid-state battery plant. When it's fully operational, that one factory alone is expected to consume 50 million ounces of silver annually. Tesla is scaling production toward 3 million electric vehicles in 2026. With each EV using between 1 and 2 ounces of silver, that's 3 to 6 million ounces from Tesla alone. Meanwhile, China's solar manufacturing output hit 420 gigawatts in 2024. Each gigawatt requires about 1 million ounces of silver, equating to 420 million ounces from solar demand alone. These aren't speculators chasing short-term gains with borrowed money. These are procurement teams acting on direct instructions from the top. Secure the silver, no matter the cost. Without silver, production halts. And halting a production line costs companies like Samsung millions of dollars per day. In that context, paying $80 instead of $67 per ounce isn't excessive, it's risk management. You can't hike margin requirements to push Samsung out of the market. You can't spook Tesla with price swings. They're not concerned about volatility. They're focused on securing physical metal. That's why this silver squeeze may be unstoppable. Now let's get into the numbers, because this is where the trend becomes undeniable. I've been tracking COMEX registered inventory using CME's daily data. Here's how things have unfolded over the last 6 months. June 2025, roughly 113 million ounces. July 2025, around 108 million ounces. August 2025, approximately 103 million ounces. September 2025, about 98 million ounces. October 2025, estimated at 95 million ounces. November came in at around 93 million. By December 21st, 2025, registered inventory had slipped to 92, 4 million ounces. That's a decline of 6 million ounces over a 6-month period, averaging 4 million ounces per month, or roughly 850. 0.000 ounces each week. But when you zoom in on recent trends, it gets more concerning. Over the last 10 weeks, from October 1st to December 21st, the drop was 6 million ounces, about 260,000 ounces per week. The outflow is actually starting to accelerate. Now let's apply a conservative estimate. Suppose the drawdown rate flattens to 1 million ounces per week from here. That's a slower pace than we're currently seeing. But let's assume a best-case scenario. At that rate, how long would it take for registered silver to hit zero? 92.4 million ounces divided by 1 million per week equals 92. 4 weeks. Just over 21 months. On paper, that takes us to around September or October 2027 before inventory is exhausted. Asterisk, asterisk. But that assumes the drain rate remains steady, asterisk, asterisk, and that's a risky assumption. Here's why COMEX has historically heavy delivery months March, May, July, September, and December. These are the periods when the highest number of futures contracts go to physical settlement instead of being rolled over or closed out with cash. January 2026 won't be a big month, but March will be. If demand for physical delivery surges in March, inventory could fall by 5 to 10 million ounces in just 1 month. That alone could shorten the timeline by months. And then we have to consider unpredictable geopolitical risks. If China makes a move on Taiwan, a major bank collapses, or the dollar takes a sharp dive, industrial consumers may panic and demand immediate physical settlement on all open contracts. In that kind of event, registered silver could drain by 20 million ounces in a week. Suddenly, what looked like a 2-year problem becomes a 2-month or even 2-week crisis. So yes, if we go by the conservative numbers, we have 21 months. But factoring in delivery spikes and black swan events, we could see a breakdown as early as mid-2026. That's just 6 to 9 months away. Now let's talk about the 3 critical thresholds, because this isn't a smooth, linear path from 92 million ounces to zero. There are distinct stages where the pressure increases dramatically and the situation shifts. Stage 1 is what I call the pressure zone, from 90 million down to 60 million ounces. That's where we are today. The COMEX is still operating normally. Deliveries are being made. Contracts are being honored. But cracks are beginning to show. Wholesalers are reporting tight supply conditions. Physical silver premiums are rising $7 to $12 above spot. The gap between COMEX paper prices and London physical prices is widening. Smart investors are making moves. Institutional holders are converting unallocated accounts to allocated holdings. Industrial buyers are locking in long-term supply agreements. Retail investors are eagerly buying every dip. This phase, the pressure zone, is defined by growing tension. The market senses that something is off. Short sellers are getting nervous. Long holders are holding firm. Every week, inventory numbers are released, and each week they fall. We entered this zone back in October 2025, and we're still in the thick of it. Threshold 2, the crisis zone, ranging from 60 million to 30 million ounces. This is when cracks begin to show in the system. Once registered, silver drops to 60 million ounces. The COMEX faces a grim mathematical reality. The open interest in silver futures typically hovers around 140, 000 contracts. Each contract represents 5,000 ounces. That's a total of 700 million ounces in paper claims. If only 10% of contract holders demand physical settlement, that's 70 million ounces more than the 60 million ounces COMEX has available. It simply cannot deliver even a tenth of its obligations. At this point, delays start to appear. Investors who request physical delivery won't receive it in 2 business days. It will take 2 weeks, maybe 3. Premiums on physical silver explode. What used to be $10 above spot jumps to $25, $35, and possibly even $50. Paper silver might be priced at $85, but physical bars will cost $135. The 2 markets separate entirely. In the crisis zone, expect emergency interventions. COMEX may revise its policies. It could enforce mandatory cash settlement on some contracts or limit how much can be delivered. Regulators will attempt to calm markets, stating everything is operating as normal. Meanwhile, behind closed doors, banks are scrambling. If current depletion trends continue, we might reach this zone by the end of 2026 or early 2027. But if deliveries spike in March 2026, the crisis could erupt by summer. Threshold 3, the breaking point from 30 million ounces down to 0. This is the final collapse. Once inventories fall to 30 million, the COMEX is barely functioning. Leverage becomes extreme. Physical reserves are too low to support operations. Here's what likely happens at the breaking point. The COMEX invokes force majeure. They activate emergency clauses, stating, due to extraordinary and unforeseen market conditions, physical delivery of silver contracts is temporarily suspended. All settlements will be made in cash based on third-party price benchmarks. Just like that, the futures market dies. Contracts that were trading for $110 are settled for $85. The shorts survive. The longs holding contracts lose out. But the physical silver market rockets upward, because at that point, the truth is undeniable. The paper pricing was always artificial. Physical silver becomes the only price that matters. And if you want real metal, you pay whatever it takes, $150, $200, $250. There's no official pricing mechanism left. All that remains are direct negotiations between anxious buyers and cautious sellers. The breaking point doesn't come gradually. It arrives suddenly and brings systemic collapse with it. One day, the exchange is open as usual. The next, it's shut down. If current patterns persist, the system could reach its breaking point by late 2027 or 2028. But if the outflow of inventory speeds up, it could happen as early as 2026, possibly even within this year. You might be wondering, can't the eligible stockpile rescue the situation? After all, aren't there still 227 million ounces that could be moved into the registered category technically? Yes. Any eligible silver owner can choose to reclassify their holdings as registered. But here's the critical question. Why would they? Put yourself in their shoes. You're holding 5 million ounces of silver in a COMEX-approved facility. It's marked eligible, meaning it's yours, untouchable, unless you say otherwise. Now imagine COMEX calls you and says, "We're short on deliverable silver. Can you reclassify your holdings so we can meet contract obligations?" Your logical reply is, "What's in it for me?" They offer, "to pay you spot price." But spot is sitting at $67, while physical dealers are moving metal at $75. You can see the shortfall worsening. If you wait 6 months, your silver might fetch $100 or more. Why sell now and help them? That's the core issue. The people who hold eligible silver aren't naive. They see the same imbalance everyone else does. They know inventory is vanishing. They understand industrial demand is skyrocketing. They recognize the setup for a major squeeze. So they hold tight. They wait. They don't convert. In fact, we've seen the reverse happening. Over the past year, some registered silver has been withdrawn and reclassified as eligible. Owners are deliberately pulling metal out of the delivery pool, making it off limits for future settlement. This is why relying on eligible silver to restore balance at COMEX is wishful thinking. Let's compare 2011 with 2025 because the contrast is striking. In 2011, registered inventory dropped to 105 million ounces before the squeeze began. In 2025, we're already at 92, 4 million ounces, 12% lower. In 2011, the main buyers were leveraged retail traders. In 2025, it's industrial giants with no leverage, but endless demand. In 2011, China imported about 500 tons of silver, roughly 112 million ounces. In 2025, China is importing over 7,000 tons, around 225 million ounces, doubling the amount. In 2011, there were no export restrictions. In 2025, China halted silver export licenses as of November 28th. Metal is effectively trapped within Asia. In 2011, COMEX raised margins 5 times, driving out speculators. In 2025, CME hiked margins by 50% on December 18th, and silver still rose. That lever is no longer working. The 2011 outcome, a 48% surge, followed by a sharp reversal, the squeeze was neutralized. The 2025 outcome still unfolding, but all the variables are magnified and far more dangerous. Everything that triggered the 2011 spike exists today, only larger in scale. Inventories are lower, demand is stronger, supply is more restricted, and the tools that used to control the situation are now ineffective. This isn't a repeat, it's something far more serious. Think of this as the sequel: bigger stakes, higher budget, and a much darker twist. Here's a projected timeline based on what the data is telling us. December 21st, 2025. Registered inventory stands at 4 million ounces. That's where we are right now. January 2026, expected to drop to around 91 million ounces. A relatively light month for deliveries, but the decline continues. February 2026, forecasted level is 89 million ounces. Pressure builds as available supply tightens. March 2026, the real test begins. Projections range between 88 million ounces. It's a major delivery month with wide possible outcomes. If physical demand spikes, we could see 8 million ounces vanish. If it's quieter, the loss might be contained to 2 million. Either way, this month will shape the entire timeline. April-June 2026, depending on March's impact, inventory may hover between 78-85 million ounces. If we remain closer to 85, the system holds. If we slip toward 78, the crisis phase could be near. July 2026, another high volume delivery month. Estimates fall between 73-80 million ounces. Dropping below 75 million would officially put us in the danger zone where the 2011 price spike began. August-November 2026, inventory may shrink further to 65-75 million ounces. Tensions escalate. Every COMEX update becomes a market-moving headline. Physical premiums widen. The squeeze tightens. December 2026, a heavy delivery month again. Stock could fall to between 58-68 million ounces. If we go below 60 million, we're in the crisis zone. This is the path for the next 12 months, assuming nothing major breaks. No black swans. No war headlines. No bankruptcies. No panic in the industrial sector. If any of those hit, the countdown speeds up. We could see 60 million ounces by mid-2026. 30 million could be reached by year-end. The breaking point might not be years away, it could be a matter of months. Now let's consider the bear case. What if all of this is exaggerated? What if the system holds bear point Hayshown? Mine output will increase and refill inventories. In theory, yes, but global silver production is roughly 830 million ounces a year. That number is largely fixed. Starting new mining operations takes a decade, not months. Even with doubled prices, 2026 output will likely mirror 2025. Bear point #2A. Recession could slash industrial demand. Economic slowdown would hit EVs, solar, and tech demand. Silver usage could drop by 100 million ounces. But in that scenario, investors rush into safe havens. Silver demand simply shifts from industrial to investment. The deficit stays. Bear point #3 COMEX could just change the rules, force cash settlement. Honestly, this is the most plausible option. If inventory falls to 30 million ounces, they could invoke force majeure. That protects the exchange, but wipes out contract holders. You thought you owned silver, now you're getting a check instead. Instead of delivering silver, they hand you cash at a price they choose. That's not a resolution. It's daylight robbery. And it reinforces the idea that owning physical metal is the only form of true ownership. None of the bearish arguments actually prevent the crisis. They merely present alternative versions of the same failure. So, what can you do with this knowledge? First, monitor the numbers yourself. Visit CME, Tom Weekly. Check the warehouse stock reports, and write down the current registered silver inventory. Watch the number trend downward. Numbers don't lie. When it drops below 90 million ounces, pressure builds. Below 75 million, we're back in 2011 territory, but with weaker fundamentals. Under 60 million, a full-blown crisis is approaching. That inventory figure is your signal. Second, don't trust the paper price. The spot price shown on trading platforms is based on COMEX futures contracts. But if COMEX is running low on metal, that price is disconnected from reality. The real cost is what physical silver sells for, delivered to your home. Currently, premiums range from $7 to $12 over spot. As we near the crisis stage, those could spike to $20, $30, even $50. If COMEX says $85, the real-world price could be $135. That difference tells the truth. Third, if you already own physical silver, do absolutely nothing. This crisis favors those who wait. The biggest losers will be those who trusted paper assets, ETFs, with no redemption. Futures contracts forced into cash settlement, or allocated bank holdings that go undelivered. Physical metal in your own hands can't be seized, converted, or shut down. You win by staying still. Fourth, if you're still acquiring silver, know that time is not on your side. You may have half a year, possibly 12 months. But once the registered inventory dips below 60 million ounces, the dealers will lose control and panic sets in. Available inventory is vanishing. Premiums are set to double in a flash. The time to act is during the pressure phase while the system remains intact but clearly under strain. Once we move into the crisis phase, to expect to pay triple the current price. Here's the bottom line. As of December 21st, 2025, COMEX registered silver inventory stands at 4 million ounces. That's 6 million ounces below the level that triggered a 48% price surge in 2011. The current depletion rate is about 1 million ounces every week. At that pace, inventory would hit zero in 92 weeks or around 21 months. But that estimate assumes everything stays calm. In reality, high volume delivery months, rising industrial demand, or unexpected geopolitical shocks could shorten the window to just 6 to 12 months. This isn't hype, it's all documented. The CME updates these figures daily, and anyone can check them. Registered inventory is falling. Industrial users are buying, and they're not easy to shake out. The futures market is leveraged roughly 7 to 1 against physical supply, and the usual tools raising margin requirements. Suppressing prices have already failed, as seen in December 2025. The tipping point is on the horizon. It's not years away. It's months away. Those holding physical silver could witness generational gains. Those relying on paper promises could face generational losses. I'll be monitoring the inventory week by week. When it dips below 90 million ounces, I'll alert you. Same when it hits 85, 80, and 75 million. This is the countdown. This is the single most critical figure in the commodity markets, 92. 4 million ounces. And shrinking by the week. Turn on alerts. Stay informed. Because when the COMEX system finally cracks, it'll unravel quickly. I'll be documenting each step as it happens. The pressure zone is already here. The crisis zone is fast approaching. And the collapse is not a matter of if, but when. Let's track the data.